In today's video, I'm going to look a little ahead into the future. So at this point, it's pretty obvious, I think, to anybody that we are in the early stages of a bubble in the stock market. The market is starting to go parabolic. I think we probably still have 3 to 6 months yet before we really are likely to top. We're not stretched that far above the 200-day moving average just yet. At the top, I think it's realistic that the Dow could be 50 to 60% above its 200-day moving average. And I'm also starting to think that maybe this bubble is going to be led by the Dow, kind of similar to the Nifty 50 in the what is it, with 50s or 60s, simply because we don't really have a new technology that is changing the world right now, like we had in the 80s and 90s with the personal computer and the internet. So I think we have the potential maybe for biotech to be a new leading technological shift, but just not sure it's ready just yet. So it may be that we need to watch the Dow as opposed to watching the NASDAQ. That doesn't change my expectation. Still think that the NASDAQ is going to, 10,000 is going to be a piece of cake. And then when we get into the really nutty phase, like we were with Bitcoin in December, where it went up 100% in a month, it's completely realistic that we could see something very similar happen in the stock market, where you get a 100% move in a very short period of time, 1 or 2 months. So I think 10,000 is in the bag, and then once we get to 10,000, it's not unrealistic to think that we could go from 10,000 to 20,000 very quickly. But here's what I wanted to examine. What happens when the bubble pops? Like I said, at this point, I think everybody realizes that the stock market is starting to go parabolic here, and we are in the early phase of a bubble. But all bubbles pop. So what happens when the bubble pops? Well, my hypothesis is that central banks are going to try the same game plan that they ran when the last two bubbles popped, meaning they're going to cut rates, assuming the Fed can actually raise rates above 1 or 2%, so they even have room to cut. And if they don't have a lot of room to cut rates, they're also going to run more QE. And the problem is that when a bubble pops, it doesn't really matter how much liquidity you throw at it. It's just the bubble just doesn't reflate. So the liquidity tends to go somewhere else, and we saw that in 2007 and 2008 when the real estate bubble popped, and the Fed cut rates to near zero, and all that liquidity, it didn't pump the housing market. It didn't pump that bubble back up. It didn't even rescue the stock market. Instead, it found another sector to flow into, the commodity markets, and as we all know, during that reflation, it focused mostly in energy. So let me switch over here. This is the S&P, and so you can see as the S&P was topping here and then starting to move below the 200-day moving average, the 200-day moving average starts to roll over. This was 2007 is when the real estate bubble was imploding, and what did the Fed do? Is they lowered interest rates drastically, pumped liquidity, but it didn't rescue this market nor did it rescue and reflate the housing bubble. Instead, what happened was the liquidity was coming out of real estate, and also the stock market was topping, so liquidity was coming out of here. And let me show you where it went. So here's the CRB, and you can see exactly where that liquidity went. It flowed right into the commodity markets. Spiked inflation. We had a massive inflationary spike, and it's that collapsed the economy, not necessarily just the housing bubble popping. That clearly that weakened the economy because a lot of people were highly leveraged in the housing market, and all of a sudden their real estate was dropping. They were losing money in the housing market, and then to add insult to injury, the Fed pumps a lot of liquidity, and it goes to the wrong spot. It goes into the commodity markets, raising the cost of living for everybody. And when you're a middle income family or just living paycheck to paycheck, and all of a sudden your food and your weekly food and energy bills double or triple, you start cutting down discretionary spending on everything else. And that historically has been what has caused recession, is a spike in energy ever since the 40s. Anytime the price of oil rises 100% or more in a year or less, it's usually just too big of a shock for the economy to withstand, and consumer spending just collapses, and then the economy rolls over into recession. So here's the energy, the oil market anyway. You can probably see this a little better even than the CRB, but it's pretty clear where all that liquidity went to. It came out of real estate, came out of the stock market, and it just all flowed into the commodity markets and the oil market, and that's what collapsed the economy. And then we had a deflationary period here as the global economy sunk into a recession. So moving back to the S&P, you can see, we're just now starting to move into the very early stages of a parabolic rally. I think we've probably still got, like I said, at least 3 to 6 more months before this, really opens a huge gap between price and this 200-day moving average. I'm going to want to see a similar sentiment towards the stock market as I have been seeing in Bitcoin lately. I just everywhere I look, I see average people talking about Bitcoin. I've got a friend that works at the hospital. Everybody, all the employees in the hospital are talking about Bitcoin. Other friends, hearing old ladies talking about Bitcoin in the store. I want to hear that same kind of sentiment, see that same kind of sentiment in the stock market. And I think, if this parabolic move continues for another 3 to 6 months, I think we will. I think we'll start to hear, just the average person, the person that has no idea what they're doing, starting to view the stock market the same way they were viewing Bitcoin as a sure thing, a money on a silver platter. And then when we start to hear that, then that's the point at which the stock market the bubble will pop, and then we'll get the collapse. And then that's the point at which you have to ask yourself, where does the money go? And I think the money, and I can guarantee you, smart money is already anticipating the popping of this bubble, and they're already starting to position in the sector that will benefit when the bubble does pop. And I think I can say with about 99% certainty that the sector that is going to benefit the most is going to be the precious metals. The dollar is already weak. That weakening dollar, along with tax cuts, is going to drive the bubble phase in the stock market. And then when the stock market bubble pops, the Fed's reaction is going to be to print more money, more QE. That should probably weaken the dollar even more. And I think the commodity markets in general will benefit, but I think the precious metals will benefit the most. So while the bubble in 2008 came in the energy markets, I think this bubble is going to occur in the precious metals as the bubble in 2008 was somewhat driven by a very rapid expansion in emerging markets. So it was driven by demand for commodities, especially energy, base metals, lumber. This time, the bubble in the commodity markets is going to be currency driven. I think it's going to be driven by a collapse in the U.S. dollar. So you can see in this chart, the gold market has held up much better than any of the other commodity markets during this bear phase. Gold didn't even drop below the last C wave top here in 2008. Nowhere near moving below the bear market low or this D wave low here in 2008. Gold wasn't even close to moving below that, as opposed to the rest of the commodity markets dropped down to or below their 2002 lows. So here's a long-term view of the CRB, and you can see that during this bear move down here, the CRB in oil is very similar as well. Not only moved below the 2008 low, it also moved below the 2002 bear market bottom. So the general commodity complex has been much weaker than gold. Gold has shown tremendous relative strength compared to the rest of the commodity markets. As I showed in that last chart, gold didn't even really come close to moving below this low, much less the 2002 low. So the relative strength is in the precious metals market. Smart money, I believe, is already anticipating where they need to position for when the bubble in the stock market pops. And it's pretty obvious to me. We've got this powerful rounding bottom here in gold that the smart money is already starting to accumulate long-term positions in gold in preparation for what is going to what the reaction is going to be when the bubble in the stock market pops.